A lot of people want to know how they can use a whole life insurance policy to pay off their debt. And this strategy can work really, really well. However, it's really, really important to make sure that the policy is set up correctly. And all that means is making sure that it is set up to have as much cash value as possible, especially up front, because the more cash value you have, the sooner you can then use the policy to pay off your debt. So today, we're going to look at someone who is currently looking into a whole life insurance policy with the goal of building cash value and then using that cash value to pay off debt that they have. So what we'll cover is as follows. We've got an individual. She is in her mid-40s and she's interested in getting a whole life insurance policy, and she can fund it with between $20,000 and $30,000 per year. That's actually step one that we're going to cover, because it's really, really important to make sure we don't overcommit and say go with a 30K example if in reality we can't hit that. And I'll talk about that more in a little bit. But we'll talk about funding the policy with the amount she wants to, company and product selection, which is very important, and then using the policy to actually pay off the debt that she has. She has a little bit more than $130,000, and I like her a lot, because that $130,000, it's not all hers. It is, but what she did is actually she took on a lot of debt that her mom had just to help her out. How often do you see that nowadays? And her mom's still alive. She took it on. She said, I'm going to handle this for you. So let's start with step one, which is funding the policy. So what we're going to look at here is funding a whole life insurance policy for maximum cash value. And the $2 amounts we had is funding up to $20K per year or $30K per year. So how do I make sure that it is set up to have as much cash value as possible? Well, here are the exact steps I would take. Step one, where is your money going? If it's $20,000, it can go toward one of two areas: the base premium or your PUA rider. Base premium dollars, if you're not familiar with this. First, buy you life insurance, DB, stands for death benefit. Then eventually, they show up in cash value. Whereas PUA dollars get you death benefit, but they really prioritize the cash value growth of a policy. So first, I prioritize cash value, and it also gets me some life insurance as well. You'll see exactly how it works in a little bit. I like to call it dollars that go toward the base premium, my initial insurance expense, and PUA dollars I like to call a cash dump in. So how do I get as much cash value as possible? Set the base premium as low as the insurance company will allow. If we look at some of the top companies, I can usually drive that premium as low as 10%, which leaves me room to put the other 90% toward my paid up additions rider or PUA rider. This is often referred to as a 10/90 split. So let's take a look at step one here. We're going to look at funding a policy with somewhere between $20,000 and $30,000 per year. Regardless of what the dollar amount is, we want to know the steps to take in order to get as much cash value as possible. Because remember, the more that we have in cash value, the sooner we can use that cash value to clear that debt. So how do I get as much cash value as possible? Whatever dollar amount I decide to fund my policy with, I can choose where my money goes. It can go toward what is called my base premium, which I see here in red, or toward what is called my PUA rider, which stands for paid up additions rider. How these two areas work: dollars that I pay toward the base premium prioritize death benefit, especially up front in the early years, death benefit first, and then cash value second. Whereas dollars that I pay toward that PUA rider prioritize cash value first. They do buy me life insurance as well, put $1 in my PUA rider, it might get me between $2 and $3 in death benefit, but I also see that PUA rider immediately show up in cash value, or just about all of it. You'll see an example in a little bit. But it prioritizes, again, cash value first, and then death benefit second. So where do you want to put the money? PUA rider. That's what everybody always wants. There are limits that we have to be aware of per the insurance company. And typically the lowest we can drive the premium is about 10% of our total payment, which means the other 90% we can dedicate toward our PUA rider. This is referred to as a 10/90 split. So what that means, to simplify, is if she picks option 2 and says, I think I can fund up to $30K per year. That's the most I'll ever be able to fund this policy with. Well, that means I can set my minimum at about $3,000 per year. That's what I'm committed to or billed for every year. And then I have the ability, but not commitment, to add another $27,000 per year. If I do it this way, I've taken what I consider to be a boring insurance bill and turned it into a very flexible savings asset where I can just add more money into the policy at my discretion. And I'll go over the specific details as well in just a little bit. Let's start though with a demonstration of this, of looking at $20,000 or $30K per year. So the first example we've got here. Here's a policy where we are illustrating $20,000 per year for 10 years. What's her minimum? Just about $2,000 per year, which means the other $18,000 goes toward PUAs. Add the two up, you've got a total of $20,000. What's the worst part about this policy? She pays 20 grand in the first year. She has 17.5, almost 17.6 in the first year. It's a little bit less than 90% of her first year payment. It was 18 grand, 18K of 20K is 90%. So first year is the worst year. When does she get all of her money back? Year 4. If she pays 20K per year for 4 consecutive years, that's $80,000. Year 4 is the first year she sees more in cash value than what she's paid into the policy. With this policy though, this is the most we can illustrate. Like even if she wants to pay more money than this, like we can't illustrate more going in. So we're setting a cap at 20K. So if she says during our conversations, hey, I think I'll probably want to be able to add more than 20, the highest is 30. I'd say, okay, we can look at 30 for 10 years. Do you think you'd be able to realistically do this? Or could this potentially be a stretch? I want to know that. This way we don't overshoot it in terms of policy size and such. But designing it to be able to fund 30K per year for 10 years, here's what I would look at. The minimum is about 3K per year, which gives her the option to add another $27,000 per year for a total of 30K per year. She doesn't have to add this much either. If you see an illustration and a certain funding schedule that looks like this, it doesn't mean that you actually have to fund this much every year. You can do it some years, other years you might add nothing extra, some years it might be 10K, but it's very flexible. Of course, if you add less, you will see less in cash value and long-term death benefit, but you're not required to get these huge dollar amounts in. This just shows hypothetically what it would look like if you do. So there's the funding. And if we max out the policy, meaning we're funding 10x that minimum premium, the break-even point's the same, which is pretty cool. Now watch this. Her plan is to pay off debt of about 130 grand. And what she said was, I want to fund this policy, but eventually use it to pay off the debt. This way I can clear the debt from my balance sheet. I don't have to think about that anymore. But then I'm going to focus on paying the loan back. So she could take a loan here and still fund it and pay the loan back. That might be a stretch though. And that's something I'm going to ask anyone I'm working with to make sure that we discuss that. So here's something a lot of people like. Check this out. So here's the exact same policy. Through the 5th year, it is identical. The only difference is when we hit year 6, what's happening? We're stopping the funding altogether. And this is not something she has to decide up front. She might decide to stop 6 years into it. So you can make it very, very flexible in this regard. So this shows different funding scenarios. We look at more than this just to show everybody the different what-if scenarios and make sure we really nail the policy down in terms of design. But at a high level, this is what we showed. She liked that $30K per year option, particularly funding it for 5 years, because then she can stop funding it and redirect her efforts on paying that loan down, which we'll look at. But first, a little bit of information on company and product selection, mainly company selection. So with whole life insurance, I always recommend the 4 major mutual companies: Mass Mutual, Guardian, New York Life, and Northwestern Mutual. The simple reason why is the word proof. I've gotten consistent proof of performance from them. It's not to say other companies don't produce strong results, but I haven't gotten proof from them, and I have gotten from these guys. Where the biggest form of buyer's remorse in the life insurance industry is overpromising, saying, look at all this money you'll have in this illustration long term, and then down the road it ends up being like this. And then people get upset with the life insurance industry, the company, the agent they bought it from, and this makes the playing field easy for individuals like a Dave Ramsey, who has seen a lot of bad whole life insurance policies over his career. Makes it easy for him to beat it up because we see what can happen with these. So the company selection, I like companies that have proof of performance, and then also setting it up how we looked at just a minute ago, where it's set up for high cash value. That's so important. If it's not set up right, like that's where things go south. Now, how we fund a policy, or how we can fund a policy, the company selection does make a difference. So if we look at 2 of the 4 major mutual companies, Mass and Guardian, with Mass, you can have that 10% base premium and 90% PUA. The thing is, if we set it up to be flexible, generally speaking, you've got to fund the base premium and PUA at the same time. There's ways you can get around that, but they're complicated with their PUA rider. What you can do, though, is adjust your PUA payment every year, 1 time per year, on your anniversary date. The ideal way to set up a Mass Mutual policy, what I like to do, is use a combination of what's called their additional life insurance rider, that's their basic PUA, and then also their LISR, LISR, which stands for Life Insurance Supplement Rider. When you use those 2 PUA riders, that's where you can make it quite flexible as time passes. But I've got 1 shot per year to easily adjust the payment up and down without any medical underwriting. Whereas Guardian, on the other hand, is a bit more flexible, because what I can do is set it up where I'm only billed for the minimum premium. I can pay that yearly or monthly. And then when it comes to adding additional money into PUAs, I log into my portal and just dump it in. It can even be my mobile app, and it's done via ACH transfer. And I could do a check too if I'm old school. So I do have a bit more flexibility there, but there's some other pros and cons to both companies. We use both pretty heavily. So I don't want to make it sound like Guardian's better because of the flexibility. That's an advantage they have, but there's definitely advantages to Mass Mutual too. Depends what someone's looking for. I've actually got a video here that provides more detail on both companies' flexibility and provides a side-by-side comparison. So let's take a look at a side-by-side, shall we? First, we've got Mass Mutual's 10-pay. And this is actually based on their 2025 dividend interest rate, which is 6.4%. And then as of the day of shooting this video, they declared their 2026 dividend interest rate, which is 6.6%, which means if I rerun these numbers, they'll look better than what you see here, which is pretty cool. But here, we've got the $30K per year for 10 years. The minimum is $3,700 because that includes the base premium plus a term insurance rider that we need to attach to the policy, mainly because that prevents what is called a modified endowment contract, or MEC, which is a taxable event with a life insurance policy. So the all-in minimum is about $3,700 per year. And then we've got a Guardian policy with the same $30K per year, lower minimum, $3,000, and then another Guardian policy. They're actually the same policy, but with a different PUA fee. The lower PUA fee gives you more cash value up front, whereas the higher PUA fee, the company takes more of your payment up front, so you don't see it in cash value. But the argument is they'll be able to go out in the marketplace, earn a higher return on that money that they retain, and they should be able to then give you that back and some with a higher dividend. That is all non-guaranteed though. But we do like to show clients both when we're looking at this particular product. But this shows a nice side-by-side comparison. And for our technical friends, I'll also include the annual yield and also the internal rate of return so we can see a comparison there. Pretty cool, isn't it? So that's an example of how we will progress through different companies and products. And then lastly, let's look at policy loans to pay off that debt. So, disadvantages to policy loans. Let's start here. During the first few years of the policy, the growth on cash value is very low. It takes 4 years just to break even in a best case scenario. So if I am borrowing against my policy in the early years, there is a high probability that the loan interest will be greater than the interest earned. Important to know that, and it's even more important to see that on your illustration before you start a policy. Like, people get irritated with this when they're not shown up front. It's okay to look at the drawbacks. It's better to know it up front before I start a policy. Okay, so the big disadvantage with loans is usually the early years. The advantage, I've got two of them here actually. First, everybody loves this. Your money keeps compounding when you borrow against the policy. Meaning if I've got $150,000 in cash value, which you'll see she has around the time she borrows, she keeps getting interest on that full 150 even though she takes a loan out. So that's the big upside. My money keeps moving forward for me. A lot like real estate. I still get appreciation on the entire value of my real estate even if I have a loan outstanding. And then here's a very attractive one to people. The policy loan interest rate is often lower than the loan interest rate that I might pay to a lender. But right now, that's typically the case. It's almost always the case with credit cards, and in many cases with other forms of debt too. It always depends on the interest rate environment as well. But right now and recently, it's kind of been a no-brainer to use policy loans. So let's take a look at the numbers. What we're going to look at is this policy, the one where we funded it for 5 years. So here we go. Here's our handy dandy loan workbook. This is something we provide to all IBC Global clients. This way they can always play around with the numbers to see what loans look like if they're considering leveraging their policy to use and maximize their overall net worth. You got to have fun with this stuff. So what we've got here, illustration to the left, funding, 30 for 5 years, break even year 4. After the 5th year, cash value keeps on compounding. There's my net yield, which is the net growth rate, not the dividend rate, the net growth rate. And let's look at some loans. We would run an actual loan illustration, by the way, if you're looking at loans, but this is just meant to give you a quick answer of what things will look like. So what's her goal? She wants to borrow $132,000 to pay off debt, a lot of which is debt that she took over for her mom. So she can chip away at it over the years. We're just going to wipe it out in one lump sum here. So the maximum loan you can take is typically 95% of whatever you have in cash value. So down here in the 5th year, she's got enough. The loan interest rate, this one's with Guardian, is fixed at 5%. If you pay the loan interest annually, it's discounted to 4.76%. So before we plug a loan in here, we've got our annual loan. That's where we're going to plug it in. Loan principal payments, loan balance. You'll see this populate when we take a loan, but we're really going to focus on these columns to the far right. The yearly cash value growth is what the insurance company is paying you every year. The annual interest payment is what you're paying them in loan interest, and the spread will tell you if you're positive or negative. Do you know why you're negative in the first year without any loans outstanding? It's because you paid in 30 and you have less than 30. The loss, that 12% hit in this example, is why you're negative. We want to account for that because that is the cost of the insurance policy. If you want to make that worse, set the base premium higher. That'll happen every single time. Okay, so let's take a look at paying off that debt. $132,000 loan. Okay, debt's paid off. She no longer has to deal with third-party lenders or institutions. Now the debt has really been transferred to her insurance policy, which is a private contract. It does not have any reporting to credit bureaus or anything like that. She's got a lot of freedom here. So here's a $132,000 loan. There's the balance at 4.76%. There you go. There's your interest payment. So we're assuming that she's going to pay the interest out of pocket. This will not be difficult for her at all because that $6,300 per year, she's paying a lot more than that right now in cash flow on the $132,000. So $62.83, cool, that's the interest. What did she earn that year? There's the growth, $4,400 and change. That is 2.94% on 156. That's where that $4,500 comes from. So the difference between those two is this guy, negative $1,800. It hurt her a little bit in this year. The next year, she stops funding the policy, which allows her to then begin to repay this loan. So check this out. Before she makes any principal payments here, the policy earned about $6,000. She paid about $6,300. So she's at a loss, $244. How much you want to pay? She was funding 30. She's not doing that anymore. She is paying the loan interest. Let's throw 25 per year at the principal. And it can vary every year. But what do you notice here? You chip away at that balance, you save yourself some money. You pay less in loan interest, which all of a sudden puts you in a good place. The earnings on the policy have exceeded the interest paid on the policy. Sweet. That's what I'm talking about. Right, Spaceman? Right. Okay. So, a $25K per year. Let's assume she continues that until it's paid off. And all we do is just look at the spread year over year. And what this shows you is I'm earning more than what I'm paying in loan interest. And the debt's paid off. Whereas before, I was just paying the credit card debt or the other forms of debt, interest was going to the institution. Interest goes to the institution here, but you also get interest from the institution, and it works out in your favor. How we made this one really work out in her favor is we did give the policy some time before we took that large loan. Got to ramp up in performance and such. Like at its peak, the growth rate is very, very close to the cost to borrow. So it's going to work if we're borrowing less than what we have in the policy. Like if we're taking a 100% loan, then it'll be slightly in our disadvantage as opposed to advantage. But anyway, this is exactly how she's using her policy to pay off debt. And this is one of my favorite things to do when we are preparing models for clients, meaning show them how to maximize the cash value, show them how to use the cash value, and see what it looks like when it's all said and done. Hope you enjoyed this one. If you did, please let us know your thoughts below. And as always, I hope this helps.